Hello, and welcome to the next edition of the Capital Stewards Podcast. Today, we're going to talk about annuities. Should you buy an annuity? Are they helpful? Are they useful for your situation? Are they just being sold by insurance salesmen that have a lot to gain from selling the contracts? We're going to dive into all things annuities in this episode. Annuities are like any other financial product. They're useful in some situations and they're useless in other situations. The real issue with annuities, like other kinds of insurance, is that they're often sold and promoted by salespeople masquerading as financial advisors. And these folks are good salespeople. And so they'll find a way to fit their product into your needs. And that's not what we want to be doing when you think about financial planning. So at the end of the day, regardless of your situation, they're going to recommend an annuity. And we don't want to be in that kind of a situation. We want you to be working with folks that are thinking about you first, that are putting your interests first. And that does not mean that annuities are always bad. So in this episode, we're going to shine a light on annuities when they make sense, when they don't make sense, and how you can get good advice on whether an annuity would be useful in your situation. So from the get-go, it's really important to talk about who you're working with when you are thinking about purchasing an annuity. Like I mentioned, a lot of annuities are sold by insurance salespeople. And so instead of taking their word for it, you need to work with an advisor that is a fiduciary, particularly a fee-only fiduciary that can help you assess your situation and determine the right retirement income planning investment solutions to meet your needs. When you think about your retirement situation, you need to start with your income needs, your assets, your risk tolerance. A real advisor can help you assess all of those dimensions and make a recommendation on whether or not an annuity or some other solution would be the most beneficial for your situation. Perhaps you've heard that you have to work with an insurance agent to buy an annuity or another product, and all people charge fees, so it doesn't really matter who you work with. There are now multiple insurance platforms that work with fee-only investment advisory firms like us to help clients acquire the insurance and annuity products that they actually need after, and this is the key, after the right financial planning has been done up front. A lot of those products are commission free. So before you even start thinking about whether an annuity makes sense in your situation, make sure you're getting your advice from an advisor who's a fiduciary that's got your best interests at heart and not an insurance salesman. All right, I'll get off my soapbox now. So there are probably as many types of annuities out there as there are types of investments. So we can't cover every single possible situation in this episode, and they can be fairly complex. But broadly, there are variable annuities, fixed annuities, and indexed or fixed index annuities, FIAs. When you think about an annuity, you probably think about a fixed annuity. In these kinds of annuities, you pay the life insurance company an amount, say $500,000, and they provide monthly income for the rest of your life. You know the rate of return and the terms up front. It's fairly straightforward. You have a really high degree of certainty about the income that's going to come from that particular investment over the course of your life. Fixed indexed annuities work in a similar way, except instead of a fixed payout, you receive returns based on an index like the S&P 500, but with limited upside and downside. It's kind of like portfolio insurance. So if the index goes up, say 15%, you only receive 10% return. But if the index goes down 10%, you might not lose anything. So there's a more stable return stream that is included in a fixed index annuity. And then lastly, variable annuities combine insurance with more traditional mutual fund investments. The owner receives the returns of those investments and has some form of income guarantee as well. So the major drawback to annuities is the fee structure, which is usually much higher than earning returns and income through a balanced portfolio that's built out with ETFs and index funds. Annuities layer in commissions, administrative fees, underlying management fees for the investment options, and so they're just fairly expensive. But the benefit of those extra fees is generally a lifetime income guarantee, and that doesn't apply to traditional investments. So the trade-off is higher fees for more certainty. So that's what we want to get to is scenarios where we're willing to make that trade of higher fees for more certainty. And those are the kinds of scenarios for most people that annuities might make sense in. So when would an annuity make sense potentially for investors? In my view, annuities can be useful in two situations. The first is for risk-averse individuals that are willing to pay that higher fee structure that we talked about to secure an income guarantee. And then the second is for very high income individuals or individuals that are looking to avoid estate taxes. And that's kind of the second scenario. We'll talk about that in a minute. So the first group, though, I think is more common. That's the use case that we see more often. So let's start there. If your risk tolerance is very low, an annuity might help you be a better investor and achieve higher risk adjusted returns. The income certainty that you gain from an annuity contract might allow you to invest the remainder of your assets in stocks or other growth oriented investments that have volatility, and the overall result might be sort of a more efficient portfolio that has better returns. But there's three things that you need to keep in mind in order for that strategy to work. So if you are really risk averse, these are kind of the three questions that you should be asking yourself. The first is to make sure that you aren't already over annuitized. So if you have Social Security, that's a form of an annuity. If you have a pension or some other lifetime income source, that's another sort of source of income that works like annuity. So it's worth considering whether you really need more guaranteed income. If you've already got a lot of guaranteed income, if that mostly covers your expenses every month, do you really need to purchase an annuity? Second, interest rates need to be high enough to generate that income. So when interest rates are lower, stocks and other assets like real estate will provide sort of better return profile. So you really need to be in a high rate environment. We're actually in a fairly high rate environment right now. So I think that's probably why we're getting lots of questions about annuities, and that makes sense. I think annuities make more sense in high rate environments than they do when rates are lower. And then the third thing is you really need to have outside assets. A lot of times annuity sales folks will try to get you to invest everything into an annuity. Annuity rates are not adjusted for inflation in the long term. That's really, really important. That means that your monthly payout is going to decline over time on a real basis or on an inflation adjusted basis. As prices go up, that fixed payout that you get is going to buy less and less stuff. So you really need to have other investments that are still invested elsewhere. Like I mentioned kind of at the beginning of this scenario, annuities make sense when an annuity is part of a broader portfolio and where those other investments can help hedge against rising inflation and help protect your real income level over time. So I started this part of the conversation talking about risk tolerance. A good test on your risk tolerance is your prior history. Have you been a long-term investor in the stock market? Have you sold out during prior market declines? If you haven't been a long-term stock investor, if you haven't done that successfully, or if you have tended to panic and sort of sell out during market declines, then you might be a good candidate to replace some of your portfolio with an annuity. Remember, even sort of if you work with a fiduciary and they help you find a low-cost commission-free annuity, it's likely going to be more expensive than other traditional options. So you're trading the higher cost for more certainty from an insurance company, and that makes sense. You do this with car insurance all the time, right? We pay car insurance, and we're just insuring against the tail risk of, in this case, running out of money, or in that case, having an accident and our car being a total loss. So if you're very concerned about generating retirement income, if your risk tolerance is really, really low and you have the right asset mix and the rate environment is conducive, then a fixed annuity might be a good option for you. So again, there's a lot of complexity here, and it's worth talking to somebody who can actually help you go through the different scenarios, look at all the options, and find the right tools that make sense. The second scenario where an annuity might make sense is as a tax planning tool. And I want to put a big disclaimer here at the top, because much like whole life insurance, here we're really talking about edge cases with individuals that have really high income or high asset levels. Annuities are often sold by folks that'll say, hey, this is a great way to build tax deferred wealth or to grow your assets tax free, all those kinds of things. For most people, that's a myth. If you have a high income, you can contribute north of $60,000 to retirement accounts. So if you aren't contributing, I think this is a good test. If you aren't contributing more than $60,000 each year to some combination of 401ks, IRAs, and Roth accounts, you probably don't need another way to shelter investment gains from taxes. If you are contributing more than $60,000 to retirement accounts, then you need to do an analysis to determine whether you really want to defer more taxes into the future. We see this a lot now. We see folks with really high balances in 401ks and IRAs. And sometimes it makes sense to save just via traditional taxable investment accounts so that you can pay lower capital gains tax rates in the future. Income tax rates, when you pull money out of one of those tax deferred accounts, you're paying income tax rates. Those can be for high income folks in the 30s, right? 31, 32, 35, 37%, depending on what happens with tax policy. Capital gains rates right now, the top rates is 20%, and then potentially some excise taxes on top of that, depending on what your exact situation is. So the capital gains income tax rate is lower. And so it may make sense for you just to pay income taxes now and not owe any, future income taxes in the future. So deferring all of your income taxes to a later date might result in you paying more taxes over the course of your life. And we don't want to do that. So if you have a really high income and you're thinking about annuities, talk with your investment advisor and your tax advisor about whether they make sense. A good indicator of whether an annuity might actually make sense for you is that your sort of your CPA, your financial planning professional, your investment advisor, and a potentially an annuity person or a salesperson that's selling you that annuity should all be aligned. If they're all aligned and they're all on the same page about how this is going to work for you, then it might work for your unique situation. If they're not aligned, if you feel like, hey, my CPA and my financial advisor are kind of telling me that maybe an annuity is not really the right thing, then you should think twice about that before you go buy an annuity. I haven't covered fixed index annuities or variable annuities yet, and that's intentional. I see very few situations where these things are the best option for investors. Variable annuities combine mutual fund investments with some form of insurance or a return guarantee. The total fees in variable annuities tend to be really high. And I wish I could put some charts up and like sort of show the fees, but the reality is annuities are so complicated that an average doesn't make sense because there are some that are really expensive. There are others that are less expensive. But the reality is in any kind of variable annuity, you've got annuity fees layered on top of generally actively managed mutual fund fees, and all of that together, results in fees that are way above what you would typically see in a portfolio that is designed to just build growth through index funds and ETFs. There are more cost-effective ways to achieve portfolio growth than through variable annuities. So I don't view variable annuities as a particularly useful tool for most investors. Fixed index annuities, or FIAs, they're kind of a hybrid of sorts. As I mentioned earlier, they kind of offer limited upside and limited downside. So that's that scenario where the market's up 15% and maybe you get 10% of that in your annuity contract. And on the other side of that equation, if the market goes down by 15%, maybe you don't lose anything or you only lose 5%. This is essentially a portfolio insurance strategy. The insurance company is buying the index and then they're using derivatives to manage the risk. And investors can do exactly the same thing. And insurance companies and annuities are not valuable because they are sort of like super investors and they have access to things that other investors don't have. And they're somehow doing something that couldn't do as a normal investor. Insurance companies are able to offer annuities because they have a pool of people that are going into those contracts, and some of those people are going to pass away and they're ultimately not going to need all of the money that the insurance company has reserved against that contract. And so they're able to use risk management tools and good underwriting and things like that to pay some people sort of more money and other people less money, and to make some profit as well on top of that. They're not super investors. They don't have access to super special investments that nobody has access to, all those kinds of things. They're just doing the same stuff that everybody else can do. So in a fixed index annuity, if you say, hey, what I really want to do is build a portfolio that's going to grow at a sort of a certain level every year, that's going to have limited risk and limited downside, you can do that through traditional portfolio management, through owning a mix of assets, stocks, bonds, real estate, commodities, gold, all those kinds of things. You can also do that through working with a financial advisor and buying options or using other kinds of futures and derivatives to manage specific risks within the equity part of your portfolio. So it's fairly low cost to do that. It doesn't cost a lot of money. It's more complicated than just simply buying and holding an index, but it's not so complicated that a good investment professional can't help you do that. So I don't view fixed index annuities as necessarily all that useful, because I don't think you need the annuity wrapper in that case to do that. Again, short of some really specific tax reason, which you should talk to your tax advisor about, not an annuity salesperson, if you're working on a really complicated tax or estate planning strategy. So in conclusion on annuities, I don't view annuities as a good tool for generating long-term growth. It's not generally something you want to buy now and hope it's going to grow and grow and grow and then pay out income into the future. The research does show that annuities are potentially a good tool for generating income for risk-averse investors when they're combined with other types of assets. So back to where we started, a good advisor that's a fiduciary is going to have multiple tools in their toolkit, and they can help you find the ideal solution for building a retirement portfolio. That should include traditional investments, insurance, and annuities. If they only do one of those things, that's a good sign that they might not be evaluating all the options and recommending the one that's in your best interest. So work with a fiduciary. They can help you sort out the complexities of the annuity market and whether they make sense for your situation. So I hope this is kind of a helpful background on annuities, what they are, where they are potentially useful and some of the things that you should think about if you're thinking about, an annuity. If you have questions or if you'd like to talk to a professional about retirement planning, retirement income, annuities, any of those kinds of things, that's not going to try to sell you something that you don't need, always happy to engage in a conversation with you. So reach out anytime. There's a link in the notes on the podcast episode and on the video for you to reach out. All right. We'll look forward to talking to you down the road.